Okay, we will go ahead and get started. Good morning or good afternoon, depending on where you're joining from. Thank you all for joining us today for the release of the National Fair Housing Alliance's inaugural State of Equitable Homeownership Report. This report provides an analysis of housing and homeownership data, focusing on the period from just before the COVID-19 pandemic to the present. We use the most recent available data sources, which generally span the period from 2019 to 2024. NAFA uses this data to inform policy recommendations to promote and preserve housing equity and homeownership, particularly for historically underserved groups. Although NAFA and its member organizations have fought for housing rights for many decades, much of this work was spearheaded by its Keys Unlocked Dreams initiative. Keys Unlocked Dreams, or KUDDI, was launched in 2019 to engage in research, advocacy, partnership efforts, education and outreach, and advancement of programs and products to help close racial homeownership and wealth gaps for Black and Latino households. Sorry, technical glitch there. Today we'll hear from Lisa Rice, President and CEO of NAFA, Jamil Khan, Housing Market Data Scientist, and Maureen Yap, Vice President of Public Policy and Senior Counsel for Fair Lending. I'm Lori Benner, Associate Vice President of Housing and Community Development, and I'll be moderating today's session. This webinar will be recorded and posted for later viewing. If you have any questions as we go, please post them in the Q&A box and we will address them at the end. I want to pause briefly on this graphic because it helps set the tone for some of the information you'll be hearing about today. NAFA is a fair housing organization, and while we think about fair housing through a discrimination-focused lens, NAFA views fair housing as a broader civil rights issue. We approach the housing and finance systems through this where you live matters lens, meaning that the location of one's home determines access to the amenities needed to live a financially stable and physically healthy life. At this time, I'd like to invite Lisa Rice on screen for a conversation about the report and the state of housing equity in this country.
Hi, Lori.
Hi. So, Lisa, I know that you like to side-eye me when I refer to your very extensive experience in fair and affordable housing, but I think you know it comes from a place of admiration for your, longevity and commitment to the cause.
You're not just trying to tell me I'm old, Lori.
I am definitely not. NAFA is part of the Black Homeownership Collaborative, which is a coalition of over 100 organizations working to reduce racial and homeownership gaps. That collaborative is housed at the National Housing Conference, and under this initiative, the goal is to add 3 million net new Black homeowners by 2030. Based on the homeownership report that NAFA is releasing today, are we on target to reach that 3 million by 30 goal?
Well, first, let me start out by saying, Lori, you and the team at NAFA have just done an amazing job in pulling together this report. As I was going through it, I was just amazed and in awe at all of the data that you guys pulled together and the great analysis and the recommendations. So I can't wait to hear the rest of the presentation. But you're right, NAFA is a founding member of the Black Homeownership Collaborative, and we serve on the steering committee. And to answer your question, unfortunately, Lori, no, we are not on target to reach that 3 million by year 2030 goal. So if we continue at the current rate, we will fall short of our goal by about 1.25 million homeowners. So that means that by the year 2030, we will have only reached about 58% or a little over half of our goal. To get there, to get where we want it to be, we would have had to have reached a total of 9.46 million net new Black homeowner households by 2030. And from 2019 to 2023, we actually only added 675 net new homeowners. So that means that at the end of 2023, we were only at about 7 million households. So we've got some work to do.
Yeah. That's a great point. And so similarly, NAFA joined forces with the National Association of Hispanic Professionals, Real Estate Professionals, and its Hispanic Wealth Project to reach their goal of a Hispanic homeownership rate of 50% by 2024. Now, I don't want to jump ahead too much because we're soon going to have a preview of all of the data, but still we know that the Hispanic Latino population is leading the way in terms of household formation and home buying. How can we continue to support that growth?
Yeah, Latino households, you're right, Lori, they're leading the way when it comes to homeownership growth. In fact, the Latino homeownership rate is in many ways, I think, leading the growth in the overall increase of homeownership numbers that we see. And that growth is extremely important for our economy when you think of it that way. I think that Latino households are actually poised to drive nearly 70% of all net new homeownership through at least 2040. So we're talking about a very important segment of our market. To ensure we don't lose ground, I think we have to do a couple of things. The first is preserve the tools that we have that have helped to really buoy the Latino homeownership rate. One of those tools is the I-10 loan. People who don't have a Social Security number but have federal tax obligations are required to obtain an I-10 number, and that's how they pay taxes. Now, most mortgages require borrowers to have a Social Security number, but there are some programs that allow borrowers to secure a loan with an I-10 number. Unfortunately, those loans carry higher interest rates and they come with really stricter underwriting requirements. But it's an important product for the kind of growth that we have seen in the Latino market, and we need to do everything that we can to preserve that. Additionally, we know that many Latino households, just like other immigrant households, are disproportionately multi-generational and may have more than one person contributing to the mortgage payment. So underwriting guidelines that support homeownership for multi-generational households is really important, and we need to make sure that continues.
That's a great point, and I'd love to see. This is a complete aside, but I'd love to see, the construction industry catching up with that as well in terms of creating units that are set up for multi-generational living, particularly ones that aren't, luxury priced.
Exactly.
Now, later in this presentation, we're going to hear from Maureen about NAFA's policy priorities as it pertains to issues to preserve and advance homeownership, particularly among underserved groups. But how would you say that the nation is doing in supporting homeownership and economic stability for America's middle class?
Well, that is a great question. So we need about 7 million more units of affordable housing. We are nowhere near meeting that goal. There are a lot of barriers that are still in place that thwart us from being able to really grow the number of fair and affordable housing units that we have. So we need to pull out all of the tools to support the development of units that people can afford, to your point about luxury units. We also need to ensure, Lori, that these affordable units are located in communities that are well-resourced. So that takes me back to the point you were making about where you live matters, right? We want housing to be located in areas that have a solid infrastructure, that have healthy environments, and that have the services and amenities that people really need to thrive. And as you noted, that is a whole part of the affirmatively furthering fair housing framework or the affirmatively furthering fair housing provision of the Fair Housing Act. It's designed to do that. And I noted that HUD recently stated that one of their goals is building more healthy housing and healthy communities. And that is a lofty goal that HUD should have. But if you just add the tagline, free from discrimination, that coupled together is the very essence of affirmatively furthering fair housing. So we really need to promote the affirmatively furthering fair housing, or the where you live matters provision, and not retrench from enforcing the law. And finally, I think we really need to build more housing stock, Lori, that is resilient and can withstand the severe weather events, the increase in severe weather events that we've been seeing and will continue to experience.
Absolutely. I think that's top of mind for a lot of folks, especially right now, as a lot of this country is under a heat wave. I just came from Phoenix last week where it was, I think, over 115 degrees. I'm one of those, I love summer people, but that was really kind of pressing my limits. Now, we
Yeah.
keep talking about this where you live matters approach. What are some of the pressing topics that NAFA and other housing advocates are concerned about as it pertains to barriers to prosperity?
Sure. So let me stay on this topic that you and I have just been talking about for a minute. We know that place is inextricably linked to opportunity, right? Where you live, your zip code determines your outcomes in life. And that is because, in part, people of color disproportionately live in communities with food deserts, with health deserts, with banking deserts. They also disproportionately live in communities that have less resiliency. So fewer green spaces, less tree canopies. People of color disproportionately live in communities that get hit the hardest by floods and by severe weather related events. And one of the challenges that we're seeing people facing is the problem of procuring homeowners insurance. And it is directly related to this increase in severe weather related events that we've been talking about. And what that means is that people of color are disproportionately impacted by this housing unaccessibility and housing unaffordability challenge. So we are working, that's an issue that we're working on at the National Fair Housing Alliance, and really trying to join force with other organizations and entities that are working on the same issue.
That's great. Now, I'd like to wrap up our conversation before we move on to the next portion of this presentation. During the introduction, I mentioned NAFA's Keys Unlock Dreams initiative. It started as a 3-year project, but through the work we've done through our research and our partnership efforts, really clearly demonstrates the need for ongoing support and attention. Where do we go from here? What's next?
I think the most important thing that is next, Lori, is that we not lose the grounds that we have gained. We've made some tremendous advancements. We're getting ready to hear about some of those advancements with the coming presentations, but we are going to lose ground if we don't preserve the civil rights protections that our ancestors fought so hard for us all to have. And then the last thing that I'd say, Lori, is that we really need more partners in this fight for fair housing. We really can't go anywhere from here unless we have people joining forces with us, because the lift is heavy, the load is heavy, but the more of us that join forces means that the load gets that much lighter.
That's perfect, Lisa. Thank you so much. I appreciate you coming on and lending your expertise to us today.
Thanks for having me.
So at this time, I'm also going to, I'm going to share my screen. And I would like to invite Jamil Khan, NAFA's Housing Market Data Science scientist. Jamil applies machine learning to complex housing and lending data sets to advance fair housing and support equitable policies as part of NAFA's Housing and Community Development team. He also contributes to projects with our Responsible AI Lab, completing complex statistical analyses and data visualizations that make them understandable even to me. So, Jamil, you should have an invitation to take over control of the screen so you can go ahead and share the data with us. Thank you.
Thank you, Lori. Those are some big footsteps to follow, but I'll try to do my best. Hello, everyone. My name is Jamil Khan, and I'm a data scientist here to provide an overview of the latest trends and insights in the U.S. housing and mortgage markets. The U.S. has long struggled with persistent racial and ethnic disparities in homeownership rates and access to housing and credit opportunities. Nationwide, the homeownership rate for white households is significantly higher than for Black and Latino households. Additionally, median incomes vary widely across racial and ethnic groups, which impacts the ability to afford and access homeownership. The purpose of this webinar is to dive into the Home Mortgage Disclosure Act, HMDA, dataset, as well as the data from sources like U.S. Census and other government and industry reports to unpack the key factors shaping homeownership, borrower characteristics, and loan features for home purchases, refinance, and home improvement loans. We will also explore some of the broader market factors impacting the housing and mortgage landscape. We will start by looking at borrower characteristics, then move on to loan features, and finally explore some of the broader market factors. This analysis will help us better understand the persistent racial and ethnic disparities in access to housing and credit opportunities. Let's get started. This graph shows the median household income trends by race and ethnicity from 2010 to 2023. Median household income refers to the income level at which half of the households earn more and half earn less. A few key takeaways are that there are significant income gaps, with white and Asian households having substantially higher median incomes compared to Black, Latino, and American Indian, American Native, which is AIAN households. These disparities in household income are a critical factor underlying the persistent homeownership and wealth gaps we see across racial and ethnic lines. Understanding these income differences is crucial for contextualizing the challenges and barriers faced by underserved groups in accessing housing and credit opportunities. Next, let's take a look at the home ownership rate trends by race and ethnicity from 2016 to 2024. Home ownership rate is the percentage of households that own the homes that they live in. A few key insights here are that the white ownership rate remains significantly higher than other groups, with a 60% gap compared to Black households and a 52% gap compared to Latino households in 2024. However, we are seeing some positive trends, with Black homeownership rate increasing by 14% and the Asian NHBI ratio increasing by 9% from 2019 to 2024. These gains can be attributed to targeted efforts like special purpose credit programs, first-generation homebuyer programs, shared equity homeownership programs, and improvement in underwriting and risk assessment tools, such as increased use of cash flow underwriting and use of rental housing payment data. The 2019 changes to the Qualified Mortgage Rule, QM rule, which made access to credit easier for underserved groups while maintaining responsible ability to repay standards, also played a catalytic role in the expansion of homeownership opportunities. While progress is being made, there is still much work to be done to address the persistent racial and ethnic homeownership gaps. Let's now examine borrower characteristics. Looking at borrower characteristics help us understand the major obstacle in homeownership that various groups are facing so that we can implement the right policy and programmatic solutions to close the gaps in homeownership that we are seeing. We can start with debt to income, DTI ratio distribution by race and ethnicity in 2024. The DTI ratio is the percentage of the borrower's monthly income that goes towards debt payment, including mortgages, credit cards, and other loans. A few key points here are that we see a higher shares of Black, Latino, and AIAN borrowers with DTI ratios above 45%, which can create barriers to mortgage approval and affordability. This is due in large part because white consumers are more than twice as likely to have financial assistance from a parent, and as a result, Black and Latino consumers often have lower down payments, meaning they are required to borrow more to purchase a home. Additionally, Black and Latinos have slightly lower credit scores, which can lead to higher interest rates and mortgage payments, thereby elevating their DTI. This highlights the importance of alternative credit data and cash flow underwriting in improving access to credit for underserved groups. Addressing these disparities in DTI ratio is crucial for expanding homeownership opportunities for minority households, as they earn lower incomes than their white counterparts, which might result in higher DTIs. Next, let's look at the combined loan-to-value ratio distribution by race and ethnicity in 2024. The LTV ratio is the amount of loan divided by the value of the loan expressed as a percentage. The key insights here are that Asian and white borrowers have higher share of loans with LTV ratios below 80%, indicating larger down payment and more equity. In contrast, Black and Latino borrowers have a larger proportion of loans with higher CLTV ratios. This difference is likely because, again, Black and Latino borrowers generally have lower down payment than white borrowers, which can be due to their reduced access to financial assistance from family, or that they are less likely to own a home that can be leveraged for the next home purchase. Borrowers with higher CLTV can expect to be charged a higher interest rate, thereby increasing the overall cost of mortgage. Higher CLTV might also be a result of appraisal bias, which can artificially deflate the home's value. Lower CLTV ratios can lead to better loan terms and reduce mortgage insurance costs, giving borrower a head start for building wealth through home ownership. Moving on to loan characteristics, let's examine the median interest rates by race and ethnicity from 2018 to 2024. Mortgage interest rates significantly contribute to overall cost of home ownership. The data shows that while there are minimal differences in median interest rates between racial and ethnic categories in each year between 2018 and 2022, it is important to note that overall, interest rates initially declined by almost 60% during this period, from an average of 4.78 to 2.99%. However, interest rates spiked to around 7% in 2024, which has had a significant impact on monthly payments and long-term wealth accumulation for all borrowers. These persistent gaps in interest rates can further exacerbate the challenges faced by minority borrowers in accessing affordable credit and building wealth through home ownership. Addressing these disparities in loan pricing is crucial for ensuring equitable and affordable credit. Next, let's take a look at the distribution of loan channels by race in 2024. Loan channels refers to the different types of lenders, such as conventional, which is the private lenders, government-backed lenders, which is FHA and VA, and other non-traditional sources. The key insights here are that there are two most prevalent loan types across all races and ethnicity are conventional and Federal Housing Administration loans. Over 90% of Asian and over 80% of white borrowers used conventional financing, while Black and Latino households are more likely to receive FHA and VA loans than other borrowers. The greater reliance on FHA loans can lead to higher cost and less favorable terms for these borrowers. Expanding access to affordable conventional loan products for underserved group is an important sign and step in promoting homeownership equity. Continuing with loan characteristic, let's examine mortgage application denial rates by race and ethnicity in 2024. Denial rate is the percentage of mortgage applications that are rejected by lenders. The data shows that Black at 27%, American Indian, American and Alaska Native at around 25%, Latino at 22%, face significantly higher denial rates compared to white at about 16 and Asian at about 14%. These persistent disparities in denial rates between minority and white borrowers stem from a complex mix of historical, structural, and economic factors, including discrimination, redlining, algorithmic bias, the dual credit market, appraisal bias, and economic factors. While there has been progress in reducing overt discrimination, systemic and structural inequalities continue to drive these disparities in mortgage lendings. The 2024 denial rate mirror a long-standing trend, suggesting that for underserved group to fully access quality credit and build generational wealth, stubborn barriers must be addressed through increased enforcement and broader efforts to remove systemic obstacles to responsible credit access expansion. Now, let's shift our focus to market factors, starting with the issues of housing cost burden. Housing cost burden refers to the percentage of household incomes that is spent on housing-related expenses, such as rent or mortgage payments. The data reveals that for both renters and homeowners, housing cost burden is much more likely for households that are Black and Latino. These higher housing cost burdens can limit the financial flexibility and savings ability for underserved households, making it more challenging to achieve and sustain homeownership. Finally, let's look at the trends in the home inventory and median listing prices. Home inventory refers to the number of homes actively listed for sale, while median listing price is the middle value of all the home prices on the market. The key insights here include active listings have declined significantly from over 1.1 million in 2017 to just about 665,000 in 2024. This decrease in housing supply has led to a substantial increase in median listing price. The graph shows that as the number of active listings decreases, the median price tends to trend upward, indicating that the housing market is steadily tightening. These market conditions can disproportionately impact the ability of first-time and lower-income buyers, including many from minority community, to enter the housing market. We don't have enough time in today's webinar to discuss every factor that's included in the report that affects homeownership. But I do want to note that there are a few other factors that play a larger role in homeownership gaps that we are seeing today. For one, insurance costs is in nearly every market across US are escalating rapidly, making homeownership expensive to obtain and maintain. And this is disproportionately the case for formerly red-line communities that often disproportionately shoulder the effects of climate-related disasters. The gaps are also fueled by persistent and ongoing discrimination in homeownership-related housing transactions. We have included in the report the latest data on sales, lending, and appraisal discrimination that adversely affects homeowners of color. In summary, the data analysis has revealed several persistent racial and ethnic disparities in homeownership, borrower characteristics, loan feature, and market factors. While we have seen some positive trends, such as narrowing homeownership gaps and increased homeownership rates for certain underserved groups, there is still much work to be done to address the systemic barriers that continue to limit access to housing and credit opportunities. Collaborative efforts include involving advocates, government agencies, industry stakeholders, and philanthropic organizations that will be crucial in promoting equitable access to homeownership and closing long-standing racial and ethnic wealth gaps. And my colleague Maureen Yap will discuss our recommendation for such efforts. I encourage you all to review the 2025 State of Homeownership Report for more detailed information and policy recommendations on these important issues. Thank you for your time today. Back to you, Laurie.
Thanks, Jamil. So many of you may be wondering where you can see these charts and read more about the data. We're going to drop a link to the report in the chat during the audience Q&A portion of the presentation. So at this time, I would like to invite Maureen Yap on screen to provide an overview of NAFA's public policy recommendations. Maureen is our Vice President of Public Policy and Senior Counsel for Fair Lending. She focuses on fair lending, appraisal discrimination, automated systems and AI, and housing finance reform. Maureen has worked in fair housing and fair lending since 1995, including leading civil rights and consumer protection issues at the Federal Reserve Board. Thanks, Maureen.
Thanks, Laurie. First, we'll discuss the importance of upholding fair housing and fair lending policies. And let me make sure I can make this work. Yeah, there we go. Okay. Unfortunately, this administration is undermining fair housing, worsening the fair and affordable housing crisis, and putting home ownership farther out of reach for everyone, particularly people of color. With respect to policies, the administration began by using executive orders to attack diversity, equity, and inclusion, including attacks on disability and accessibility, sexual orientation and gender identity, and immigrant rights. Of course, an executive order is not a law and cannot overrule existing statutes, regulations, or case law. At this time, NAFA is engaged in litigation with the administration with respect to these executive orders. The administration has also attempted to dismantle the disparate impact theory of discrimination by executive order. Of course, the disparate impact theory was specifically upheld under the Fair Housing Act by the Supreme Court in the Inclusive Communities case. So again, while the administration can choose not to use this theory in its civil rights advocacy, it cannot use an executive order to overrule statutes, regulations, and case law. Finally, the administration is attempting to undermine fair housing education and enforcement by reducing the staff and resources at key federal agencies, including HUD, the DOJ, the CFPB, and the Federal Housing Finance Agency. Several organizations are in court fighting these actions. At the same time as the administration is dismantling federal resources, it is also undermining funding for local resources by reducing current funding and proposing no future funding under HUD's Fair Housing Initiatives Program, or FIP. NAFA is actively litigating these actions as well as advocating on the Hill for full funding for FIP. Then, as the administration squeezes both the federal and local resources for fair housing, the administration has proposed a budget with the same amount of funding for states and localities through HUD's Fair Housing Assistance Program, or FAP. That is, the administration is not proposing any increase in funding for FAPs to make up for the shortfall at the federal and local levels. So the first step here is to defend the established rights, resources, and freedoms that have long enjoyed bipartisan support and long protected access to housing. Next, we recommend that policymakers, as well as private stakeholders, implement fair homeownership programs to close the wide and persistent homeownership gap between Black and Latino households and white households. For instance, as Jamil described, decades of discriminatory policies have caused a wealth gap that makes it difficult for households of color to save up the money for down payment and closing costs. Effective programs include special purpose credit programs that provide funding for historically underserved areas, or first-generation programs. Other effective programs include inclusive credit score models and underwriting with positive rental payment history. We also have long advocated for FHFA to eliminate the Fannie Mae and Freddie Mac loan level price adjustments, or LLPAs, which were added to mortgage costs during the Great Recession, but somehow remain as an unnecessary additional cost for borrowers. Next, as Lisa and Jamil mentioned, we recommend addressing the issue of climate change and its impact on housing. And once again, the administration is worsening the fair and affordable housing crisis. HUD has terminated the $1 billion Green and Resilient Retrofit program, which would have made HUD-assisted multifamily properties safer from natural disasters. So we recommend that policymakers and private stakeholders offer grants, loans, and discounts for homeowners and multifamily properties to upgrade their housing to ensure resilience in the face of climate change. We also recommend that policymakers and insurance companies ensure that the pricing models take climate change and sustainability into account, while also ensuring fair access for all communities. Next, we turn to servicing once the consumer is in their home. Any household can fall on tough times due to rising prices, an unstable job market, or a personal health crisis. We learned during the pandemic that government and private stakeholders can provide programs that help borrowers get back on their feet during tough times. So we advocate for continuing those programs, including the FHA Loss Mitigation Waterfall, the FHA HAMP program, and the CFPB Mortgage Servicing Rule. But once again, the administration is inexplicably making tough times worse for the everyday consumer. The administration has canceled the Veterans Affairs Servicing Purchase Program, or VASP, which helped veterans avoid foreclosure by allowing the VA to purchase defaulted VA-backed home loans from mortgage servicers and then modify the loan terms. NAFA advocated on the Hill for continuation of the VASP program by joining Representative Mark Takano and Representative Chris Pappas, as well as the National Consumer Law Center, for a press event urging the VA to reinstate the program, which could help thousands of veterans, including veterans of color. Next, as Lisa mentioned, we recommend greater efforts to create inclusive, thriving, healthy communities. As you know, the Fair Housing Act requires by law that all federal agencies affirmatively further fair housing. Once again, we regret to report that the administration has undermined this law and the opportunity to create inclusive communities by issuing an interim final rule that provides a heavily watered down minimum requirement for a locality to merely certify that it affirmatively furthers fair housing. NAFA advocated to overturn this rule by submitting a comment letter to HUD with the support of over 130 civil rights, consumer, and housing advocates, including local fair housing groups from 35 states. In addition, we recommend that policymakers and private stakeholders continue to advocate for inclusive zoning that allows for many types of housing, not just single family, and other inclusive zoning provisions. Next, while not easy in this Congress, we recommend that policymakers pass fair homeownership legislation. The top legislative priorities include the FY26 budget with full funding for FIP, FAP, and HUD's Office of Fair Housing and Equal Opportunity. The Neighborhood Homes Investment Act, which would create a federal tax credit to build and rehab affordable homes. The Down Payment Toward Equity Act, which would provide funding for first-generation homeowners. And the Appraisal Modernization Act, which would require public disclosure of appraisal data and codify a consumer's right to appeal the appraisal. Finally, we recommend that policymakers and private stakeholders work together to develop a responsible AI framework. Artificial intelligence and automated systems are a growing part of access to rental housing, for example, through tenant screening, and home ownership, for example, through automated mortgage underwriting and pricing systems. As these systems develop, we need to ensure that fair access to housing and credit are preserved. This week, we urge you to call your senators to oppose a provision in the reconciliation bill that would ban states from enforcing any state law that limited or regulated AI or automated systems in any way. We do strongly support states passing responsible AI legislation, which we hope will lead to comprehensive federal AI legislation. And with that, I'll turn it back over to Lori. Thank you.
Thanks, Maureen. Oh, this is a big thank you, as if it's the end, but it's not the end. I want to invite Maureen and Jamil back on camera for Q&A. We've got some questions in the chat. I'm kind of multitasking here. I was trying to pay attention to the chat, our internal chat, and the Q&A box all at the same time. There was a question I saw that came in about opportunity zones, and I think Lisa can address that one. So we'll get over to those in just a minute. I'll pull up the Q&A boxes here. So I see Lisa is typing an answer about opportunity zones, and that question is, what's NAFA's take on opportunity zones and their impact on fair and affordable housing? That's a really interesting question. As opportunity zones kind of reach the end of their period, there's been a lot of massive investment made, but I think that there's a lot of question as to whether or not that investment has really had a positive impact on communities of need. Possibly has it the potential for advancing gentrification. I think a lot of the investment has been on market rate rental property. So I'll let Lisa address that one in the chat. So I see a question here that looks like, or Jamil, what was the spike in 2020 Q2 for home ownership?
Hi, Laurie, can you hear me?
I can.
Okay, great. Just making sure. Yeah, that's a good question. I think there were a couple of reasons. One was the drastic reduction in the interest rate. There were interest rate cuts in 2020 during the COVID period. And we see it in the interest rate charts also, a reflection of that. I think this was early 2020, first quarter. So that explains. And also because of COVID, it was so unprecedented. I think Census Bureau had to resort to telephonic interviews, and they suspended in-person interviews. And I think that also probably reflected in how the data was collected. So the data collection probably was one of the reasons why we had less responses from the renters. And so two-pronged reduction in interest rate and then the data collection process is how I would answer that.
Okay, that's perfect. Thank you. There is a question here about speaking about rent-to-own properties from a fair housing perspective. That's a bit of a tricky one as well. I don't know if you want to speak to that at all, Maureen. I do know that from a fair housing perspective, there's some nuance wrapped up in the rent-to-own properties. A lot of them can be part of predatory type of situations, almost mimicking the old contract. Gosh, why did the term for it just go out of my head? The contract deed. What's that?
Land installment?
Yes, land installment. That's what I was trying to think of. So, a lot of the rent-to-own programs that are out there are not well set up to have the tenants become homeowners, and they can exacerbate financial issues for those folks. So Maureen, do you want to touch on that a little bit more?
Yeah, definitely. Thanks, Lori. It's definitely a complex issue. It all comes down to the terms, just like anything else. So a little bit of my history. My father was from Peru, and he was a doctor in a Detroit suburb and worked in Detroit. And as I was growing up, it turns out our family never had a mortgage, even though he was a doctor and I thought we owned the home. But I had occasion to look up our property records and confirm something my parents had said, which was nobody would give them a mortgage. So the original buyer was still on the title when we moved from Detroit to Toledo. So I don't know whether our family ever got the equity that was built up, for example. So a lot of it has to do with how the terms are set up, whether those terms are fair. Is the homeowner getting any part of the equity? Does the homeowner have the right of first refusal if the homeowner wants to sell? How are the property taxes and other things allocated? And we did see back in the day, speaking of predatory lending, with the Hargraves versus Capital City mortgage case, that sometimes ownership opportunities are converted to leasehold to avoid consumer protection, so that the state and local consumer protection laws don't apply. So a lot of it has to do with the terms. It's not necessarily a bad thing. We also, in a similar fashion, recently had a conversation about ground leases. Where a mortgage company is offering to buy the land on behalf of an investor, and the individual consumer holds the mortgage just on the cost of the property. And how is that going to work? And also now with climate change being such an issue, how is that going to work in terms of insurance? So it all comes down to the terms for most of these, and designing an equitable framework and product.
That's great. Thank you. The next question that has come in is about manufacturing homes and where they fall in the discussion of fair housing, and how does housing shortage, should they be considered as viable options? Should our energies be diverted to other priorities? The question does, of course, address the stigma around manufactured homes. This is me speaking personally. I think manufactured homes are a great solution. Of course, there's going to be some, zoning and some other issues that need to be addressed if they're to be increased as an affordable housing option. And people, if they throw shade at manufactured housing, I don't think they've really seen any more modern manufactured housing. I was just on a trip in Sedona and stayed in one, and you absolutely could not tell that it was a manufactured home. There can be some really great options there. And we need all of the options. We need all of the tools available to us in terms of fair and affordable housing. Is there anything, Maureen, that you can speak to specifically on that topic?
Yeah, definitely. So I got my start in fair lending as a paralegal at DOJ and worked on DOJ's very first fair housing mobile home case. So I did have the opportunity in Hatch, New Mexico, to tour a variety of mobile homes, and can also attest that they're really great as housing options. I think what's different in the United States is that the home is the main builder of wealth. That we don't have a very strong social safety net, so homeowners often use their home to kind of even out cash flow issues. And so in many situations, the manufactured home can be a depreciating asset. And so we have to be careful about that. We also need to be careful about steering. So just as with FHA mortgages are great mortgages, but because the mortgage insures last so long, it can be a lot more expensive. So query whether the potential homeowner should have gotten a conventional mortgage. Same with manufactured housing. it's better to have safe, stable housing than not to have access to housing. However, if folks are being steered, particularly on the basis of race or ethnicity, to certain products or certain styles of housing, based on views about their background, as opposed to based on their credit worthiness, then that can be a problem. So that's really the main thing to think about.
Great, thank you. Now here is a question that really just gets right to it. What are the chances of the Appraisal Modernization Act passing in the near future, or even just getting a hearing at the committee level?
Great question. So we are working with Senator Warnock of Georgia on the legislation, and we expect it to be introduced in a couple of weeks. Industry actually, so far, many facets of industry are very supportive of providing the data on a public level. And many lenders are not particularly worried about codifying the consumer right to an appeal, which is known as a reconsideration of value. So because they already have those systems in place, it's just basic compliance management. If you're going to offer something, you want to make sure that all of your staff offer it on a consistent basis. So there's reason to be optimistic. We don't believe that there will be a hearing or a what we believe it'll go straight to markup in the Senate, maybe sometime in July or August. So more to come on that, but there are reasons to be hopeful, unlike some of the other good ideas that are out there that probably won't be able to get attention right now.
Okay, thanks for that. We have a question here from Dana Lockwood. Boy, that's a familiar name. Where do I know a Dana Lockwood? It looks like Shanti is typing an answer to that one. His question is about reforming zoning laws across the country. Yes, there is a growing momentum to address zoning laws. And I'll let Shanti continue to answer that one. There's another question that comes up very, very frequently, and Lisa is typing an answer in the chat to that, but I don't know, Jamil, if you want to maybe say a little something about it, about the data for Asian households. That is something that we are aware of, some of the nuances in the in data sets that are not disaggregated, and how that can impact the way that the data is displayed and talked about. So it's mentioned here that it's highly skewed due to immigration laws that have historically preferred highly educated or skilled immigrants. So I don't know if you want to quickly comment on that, Jamil.
I think Lisa has probably answered much better than I can, and I let her finish her answer. But I do agree with the point made here. Some nationalities, because of the immigration laws, prefer highly skilled, highly with advanced degrees. So it does skew the distribution. So some nationalities will get favorable treatment, but other nationalities, so Indian and Chinese probably will get favorable, and that's what causes the skew in the data. But other nationalities from Asia will not get that favorable treatment. So it is a valid point, and I let Lisa finish her argument about this too.
Sure, thanks, Jamil. There's a question about if there have been changes in first-time homebuyer qualifications that could spark higher home buying stats for minority households. That's interesting because the definition of first-time homebuyer can vary. It can mean first-time homebuyer in terms of exactly how it sounds. This is your first time buying and owning a home ever in the world in life. Other programs, it can be first-time home buyers, could be someone who has not been on title to a property in the past 3 years. And as long as you're not on title to a property at the time of closing, you can count for first-time home buyers. So this definition varies widely between loan programs, between tax incentives, or closing cost incentives, things of that nature. That does vary a lot. Okay, here. There's a question, I see Lisa's typing on this one too, about involving industry professionals and organizations like NAR in proactive fair housing efforts. That's a great question. No, I'm sorry. Oh, Lisa, did you want to address that one live?
I was going to type the answer because I see we're at the end, but I could just come I just came online to answer. So most people don't know that the very first fair housing organization in the United States of America was a real estate group, the National Association of Real Estate Brokers. They were founded in the 1940s, and they were founded specifically to advance democracy and housing. They were proponents of the Fair Housing Act. They were among the first professional group to advocate for the passage of a federal Fair Housing Act. We've already mentioned, I think Lori and I talked about at the top of the hour, that the National Fair Housing Alliance has a very close relationship with the National Association of Hispanic Real Estate Professionals. We just last year, I think, joined the Asian Real Estate Association of America in bringing a fair housing claim to advance and expand fair housing opportunities for Asian Americans and other immigrant groups in the United States. We have a lot of financial institutions. We have a lot of insurance companies like Nationwide Insurance Company, for example, that work with us very closely to advance and promote fair housing laws. JP Morgan Chase was the first lending institution to publicly come out with a special purpose credit program, something that NAFA had been advocating and pushing for, and they did that in advance of HUD issuing a rule on special purpose credit programs. So industry stakeholders are extremely important. You heard me say earlier that we need more partners. We definitely need more industry groups to join us in this fight for fair housing.
Thank you, Lisa. Yes, that's exactly what I was going to say, is that we have very strong partnerships with the real estate industry associations. We have a strong partnership and have been supported by NAR. They have ramped up dramatically their fair housing education offerings for Realtor members in the last 5 years. They have this really cool program for their members. It's called Fairhaven, which is an interactive online process that you can go through, and it teaches all about fair housing and gives active scenarios. So we are at time now. There is a survey that's been put in the it says in the chat. Where is the chat? I'm not sure if so the webinar chat. Sorry, I'm trying to make sure that everyone can see. We have a survey for today's presentation in the chat. It looks like it is available to all of our attendees and not just the panelists and host. And we also have a link to the report in the chat. So again, this webinar was recorded. We will have it posted for later viewing. The report itself, although it is in the chat, it's going to be posted, or it already is posted on NAFA's website and also the Keys Unlock Dreams website. And so you can find the report itself as well as a variety of other reports and content that's pertinent to NAFA's work and our fair housing data and policies and all of those things. So with that, I want to thank our presenters today for sharing their expertise. And I would also like to thank you, the audience, for tuning in. And I hope you all have a great rest of your day. Thank you.